Inflation is slowing down. That is what they want you to believe, but the truth is very different. Today, I'll explain the data showing an inflation shock is coming and how interest rates reveal where prices are headed next. Let's get right into it. To understand the coming inflation shock, you need to understand the draining of the U.S. Strategic Petroleum Reserve, or SPR. This is artificially keeping oil prices low due to the closure of the Strait of Hormuz. So the U.S. government buys and stores oil in this reserve, which they can later release in times of severe global or national oil supply shocks or shortages, usually caused by wars or natural disasters. Well, this has exactly happened with the Middle East conflict that essentially closed the Strait of Hormuz in February 2026 this year. Now, around before the strait closed, 20 million barrels of oil and refined petroleum products like gasoline or diesel used to pass through this waterway per day. This number is big because it represents 20% of the world's consumption. So when this flow of oil stopped at the end of February, when the conflict started, the market impact was huge. Oil prices went from $66 per barrel the day before the conflict started on February 27th to $105 per barrel by May 15, 2026, an almost 60% jump in price in just 2.5 months. But you're probably wondering why oil prices didn't go to $150 per barrel or $200 per barrel. Well, you can see it here. When the conflict started, the U.S. Strategic Oil Reserve set at 415 million barrels. From March 20th to May 15th, it declined from 415 million barrels of oil to 374 million barrels of oil. That's 740,000 barrels per day on average. And this rate of decline actually accelerated. From May 15, 2026 to June 26, the reserve fell rapidly from 374 million barrels per oil to 325, or 1.15 million barrels per day. This is a situation where the Trump administration is essentially putting over 1 million barrels of oil into the market every day to try to keep prices down. Now just think about that. If you're releasing 1.15 million barrels of oil per day and you only have 374 million barrels to begin with, this means your strategic reserve will go to zero in less than a year. This rate of release is obviously unsustainable. So we later do see oil prices come down to $74 in June, partially due to ceasefires and a partial opening of the Strait of Hormuz. This is also in addition to other countries releasing oil from their strategic reserves. In March 2026, 32 member countries of the International Energy Agency agreed to release 400 million barrels of oil to ease the supply shock. Continuing from June until recently in July, the barrels of oil in the SPR decreased to around 308 million barrels, with the U.S. still releasing over 600,000 barrels per day with oil prices up to $89. And this isn't the full picture. This is just the U.S. Strategic Oil Reserve. To really understand everything that's going on, you need to look at the physical market of oil, also called U.S. Commercial Crude Oil Reserves, that's controlled by private companies, such as refiners, traders, and oil producers. This is their inventory of oil. And these private companies are actually part of the process of getting refined products such as gasoline, diesel fuel, or jet fuel to consumers and businesses that people use every day. Look at the orange line. You'll see the pre-conflict commercial reserves was at 439 million barrels of oil in February. This actually went up to 445 million by May, while the U.S. Strategic Reserve fell by over 40 million barrels. Why? Well, with the supply shock, there's likely a combination of private companies adding inventory, planning for more demand, as well as the strategic reserve boosting up that U.S. commercial stock by releasing its own barrels. Now, as we move forward from June to July, we see that the commercial crude reserves are falling too, albeit a slower pace, with those reserves down to 404.5 million barrels in July. This is very important to know when looking at this graph. There is a time limit on the Middle East conflict, especially if the U.S. strategic oil reserves continues to fall at this rapid pace. I mean, look at the numbers. A 25% drop in oil in less than 6 months from 415 million barrels to 308 million barrels. 100 million barrels gone. If the U.S. strategic oil reserve gets too low or U.S. commercial crude oil reserves continue to fall, you could see an inflation shock where we could see oil prices skyrocket, maybe going to $150 per barrel. So these are the numbers investors should be watching. But another question is, what can the U.S. Federal Reserve do about this situation? And from their last meeting in July 2026, it seems they are struggling to find out. At this recent meeting in July, the Fed's preferred inflation figure, the Personal Consumption Expenditures Index, or the PCE index, was 3.7% in June 2026. What's interesting about the details of this recent meeting is that 3 of the board members voted to increase interest rates while 9 voted to keep rates the same. Those 3 board members that voted to increase the rates noted that the 3.7% is still far above the 2% target for inflation that the Federal Reserve has. And it also seems Fed Chair Wash is now signaling that the Fed may raise rates in the future. But Wash faces a big obstacle, President Trump. Trump, who hired him to lead the Fed just a few days before this July meeting, publicly stated that the Fed should lower interest rates, and he also criticized board members advocating for higher interest rates, calling them political or having bad intentions. And Wash also faces another dilemma. The Fed can't open the Strait of Hormuz. They can't do anything to change or limit the energy inflation that we've seen for almost 6 months now. So the big question is, should the Fed make interest rate decisions based on factors it cannot control, such as tariffs or oil price spikes caused by military conflicts overseas? Well, for investors, you should not only be looking at what the Fed says, but you should be watching other important data points. One of these being U.S. Treasury rates. Specifically, the 10-year U.S. Treasury note. We can see that the rate has increased from 3.96% before the Strait of Hormuz closed in February to 4.75% today. Higher long-term Treasury rates means investors are expecting higher U.S. dollar inflation and therefore demand higher yields to invest in U.S. government debt. This is market-based, so if you continue to see interest rates go up, you can be sure that the market expects inflation to increase higher in the future. You can see the same thing with the 30-year Treasury bond rates. Over the same period, its rates are up from 4.63% in February to 5.28% today. So clearly, investors see higher inflation even 30 years out for the US dollar. What's the angle? Focus on the fundamentals. Ignore the headlines saying that inflation is starting to cool and oil prices are coming down. The question you should be asking is U.S. strategic oil reserves still falling? What's the level of the U.S. commercial crude reserves? Are long-term Treasury interest rates still rising? These figures will give you a much better fundamental picture of where inflation is going, so you won't be surprised or shocked when it happens. But these are my thoughts. What are yours? Let me know in the comments below. If you enjoyed this video, believe it has some valuable insights, hit the subscribe button, turn on those notifications, and I'll see you next time.